Hello, my name is Brenton Harrison, and we're here today to talk about how you can figure out how aggressive your investment should be. Let's get started. When it comes to investments, there are so many different ways that you can put money in things like the stock market that it can be really daunting when you're trying to figure out where to get started. Should you use index funds, ETFs? And for someone who's never done it before, it can be really overwhelming to determine not only where do I invest, but how do I invest once I get there. So what is risk tolerance? Well, really, it's exactly what it sounds like. Your risk tolerance for an investment is the amount of risk that you can withstand without feeling like you need to make a change to that account or investment. It's great that you've invested in a tool, for example, that could generate a 20% return, but if investing in that tool means being comfortable with the idea of having a 20% loss and you don't find yourself there, this is an example of an investment that exceeds your risk tolerance. It is too aggressive for your comfort level. It might put you more at ease to have an investment that has a smaller potential upside in exchange for a smaller window of potential losses. And determining where you fall on the spectrum is really important when you're trying to build a portfolio. Another common misconception is that people think that all of your investments have to have the same risk tolerance. No matter how much I have in the market, 100% has to be invested in the exact same way. And that's actually not true. As a matter of fact, I would say that you want to have different accounts have different risk tolerances because each of your accounts should serve a particular purpose. If you have a retirement account, you may have a tolerance for more risk in that account if you're 20, 30 years from retirement. But if you're investing money that you plan to use for a down payment on a home or a business 2 years, 3 years, 5 years from now, then you might not be able to withstand a huge loss in that account. And thus, you should have a lower risk tolerance for that portion of your investments. And with that in mind, let's give you 5 tips on how you can choose your risk tolerance for each of your investments. Number 1 is your time horizon, or the length of time until you need to access the funds that you've invested. Whether you're an aggressive investor or a conservative investor, the amount of time you can have that money at risk is really important in determining your risk tolerance. Even an extremely conservative 25-year-old investor should probably loosen the reins a little bit on their retirement accounts because they're decades from the time that they actually need to access that money. And in many cases, having the account be more conservative means that you're sacrificing potential upside. So while you don't want to go too far outside of your comfort level, you also don't want to risk having the opportunity to have a return that's higher and will get you to your goals, but not take that risk because you're not being realistic about what you need to do to meet that objective. As a matter of fact, for some investors, having some big downturns along the way, while it may be uncomfortable, can actually be positive for the long-term prospects of that account. Because what have you heard about investments? You've heard that the first rule of investing is to buy low and sell high. Well, as long as you're investing money consistently, like you should with a 401k or with any investment, when you have these big downturns, even though the price of these stocks are falling, which is uncomfortable to look at, it's giving you the opportunity to continuously buy those stocks at a low price. And in the long run, that will benefit your account. Conversely, a person who is 3 to 5 years from needing this money, maybe they're an older person who's nearing retirement or is for a specific goal that's close on the horizon, they really can't risk having these huge upswings and downswings in their account. And they could potentially look for more consistent returns and sacrifice the potential upside in exchange for having more predictability in terms of what they're going to get on a year-to-year basis. Number 1 is time horizon. Number 2 is net worth. I'll never forget when my wife and I were about to purchase our first home, and our realtor, who happens to be my mother, was talking to us about the type of home that we should look for. And on the first day of looking, we stumbled across this 1-bedroom condo that to me was perfect for our budget. I wanted to go down to the office and say, this is the one, we're going to put our offer on it today. And my mom actually discouraged us from putting the offer on that home because in her opinion, 1-bedroom homes were harder to resell. So if we were going to be in that house for the rest of our life and we liked a 1-bedroom home, that would be great. But knowing that we were a young couple who would eventually want to be able to sell that home for a profit, she encouraged us to look at it like an investment. I'm not saying that you should look at your home as an investment all the time, but in our particular circumstance, We did not have a net worth or a cash cushion that was big enough for us to look at that house as if it were something that we were going to be there for the rest of our lives. We needed to position ourselves based on our financial circumstances so that we gave ourselves the best chance possible for that home to appreciate in value. We needed to make sure that based on our net worth, we had an appropriate exit strategy. This too is important for you when determining your risk tolerance. The fact of the matter is, there may be some things that you're interested in as an investment, but your net worth, your financial circumstance, your income may mean that you are a little ways from being able to actually take that risk and not mess up the rest of your portfolio. Conversely, if you put yourself in a good position where you can take some risks and you have a good profile, you have assets that are significantly higher than your liabilities, you have an emergency reserve, you have a stable income, it can put you in a position where your risk tolerance can increase, because now if that investment doesn't work out either to the extent that you'd like it to or in the time frame that you need it to, you have the ability to fall back on your other assets. I see this all the time with people who are dipping their toe into the investment waters, and in reality, they're putting money at risk that they can't afford to lose. And not only can they not afford to lose it, but they're putting that investment in the riskiest things that they possibly can, because they're hoping that in a year they can go up 200 or 300 or 400%, like you've seen with some of these things that we've seen in the news. But for most people, that won't happen. For the majority of people out there, they need to invest in a way that meets their time horizon in terms of when they can access the funds, and also is appropriate based on their net worth and the amount of risk they can take with that particular pool of money. Number 3 is your investment objective. And this ties in really well to what we were just talking about with the example of our first home. I mentioned that if we had purchased that home with the intention of retiring in that home, never planned to sell it, then in that situation, we could make an investment into that property that really had nothing to do with the exit strategy or its resale value. And you find this with some investments where you could have, for example, a retirement investor who's investing in something because of the income it produces, and they're not actually looking to ever sell that stock or that mutual fund or that ETF. They're looking to generate a consistent pool of income regardless of what the end value of that stock is. Conversely, you could have someone who is really looking into a stock with the intention of seeing that long-term growth or that explosive short-term growth so that they can turn around and sell it for a profit. This is that investor or these investors' investment objective. And knowing this ahead of time can give you an idea of what's an appropriate fit for your portfolio and what actually is outside the bounds of what you're looking for. Number 4 is your investment experience. No matter how tempting, it's never a good idea to invest your money in something that you don't understand. And to me, the bar to actually understanding a topic is you being able to say that you can confidently teach that topic to someone else. It's not enough as an advisor for me to sit down with a client, put something in front of them, and explain it in my terminology, and them say, you know what, I think I understand it, and walk out the door. No, 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 no. It's only appropriate when that client can turn the paper back to me and explain in their language what I just put in front of them, because only then do they understand in what they've invested. If you found a platform in which you've taken an interest, take the time to research the pros and cons before you take the leap. Even if it meets your investment objective and your risk tolerance and your time horizon, there may be things you don't understand, like even the tax implications that need to be considered. Take a real estate investment trust or a REIT as an example. A REIT, or a real estate investment trust, is a company or a collection of investors that buy or finance real estate projects. When you buy into a REIT, you're essentially buying into a percentage of that REIT's holdings or their real estate developments. If it's a publicly traded REIT, you could be investing in dozens, if not hundreds, of properties or the mortgages on those properties, and it can give you a wide range of exposure to the real estate market at large. If this sounds attractive to you and you're bullish on real estate, then you could be saying, oh man, let me go find a real estate investment trust. But you also need to know that REITs are required to distribute at least 90% of their income to their investors each year. When they distribute that income to you, it creates a taxable event. The impact of these investments is something that needs to be strongly considered before you decide to take the leap into this investment. And that's true for anything that you put into your portfolio. If you can't explain it to someone else, then you're not in a position where you yet know if it actually meets your risk tolerance. Lastly, we have liquidity needs, or in layman's terms, when you would need to be able to access these funds. While liquidity needs may not seem like something that should be factored in when you're determining how aggressive or conservative an investment should be, it actually plays a really, really big part in how you structure your portfolio. And not just in how you structure your portfolio, you might find that a certain investment, when considering your liquidity needs, actually meets what you're trying to do, but the contribution that you make towards it could be impacted by that liquidity. A few years ago, we did a guest post for our friends at Wealth Noir about the limitations of 401ks. In that article, we talked about the fact that for most people, the age that you have to reach before you can access your 401k funds without penalty is 59 and a half years old. So while the investments in your 401k may be wholly consistent with what you consider an appropriate risk tolerance, the limitations on when you can access those funds are really important to think about. While this may seem similar to your time horizon, it's actually very different because now we're talking about how much money you should contribute towards the investment, if any at all. Considering your time horizon might mean deciding whether you should even put money into an investment that's, say, 90% stocks and 10% bonds. Considering your liquidity needs could be the difference between deciding whether to put your money in a CD at the bank that ties up your money for 3 years. And now you're trying to decide if the potential upside of the interest you'll get on that CD outweighs the cons of not being able to touch that money for a 3-year period of time. These are two different but equally important elements of determining how aggressive your investment should be. I hope this video was helpful in determining how aggressive or conservative your investment should be. While I don't think everybody has the time or wants to be an investment guru, I do think people need to know the basic terminology so that they can feel empowered to take their steps into the investing waters. My name is Brenton Harrison. If you like this content, please subscribe to our channel and subscribe to the notifications so you know when new videos are being posted, and we'll keep bringing them to you as often as we can. See you soon.